Hello, everyone. Welcome to Mongo Capital Tech Spaces. I'm your host, Sumaya Ahmed. Today, we are joined by two incredible players in the African FinTech ecosystem. Samora Kariuki, founder at Frontier FinTech, a media outlet covering FinTech across Africa, and Stone Atwine, co-founder and CEO at Eversend, a cross-border payment platform. Karibu, Samora and Stone.
Thank you for having me. Looking forward to the discussion.
The two of them will help us understand the current state of FinTech in Africa, and we'll dive into where the opportunities and challenges lie. We'll start by looking at the funding landscape. FinTech still commands the largest share of startup funding in Africa, but 2024 was a tough year marked by scarcity in funding and pressure on profitability. How different is 2025 from last year in terms of investor confidence and growth, and where are we seeing real momentum?
Thanks, Sumaya and the Mwango team for having us this evening. I'll just go back and do a little intro. As Sumaya said, my name is Stone. I'm a co-founder and CEO of Eversend, and we're building mostly cross-border payments startup focused on FX and digital accounts and stablecoins and all that kind of nice stuff. We do B2C and B2B. We started out with mainly doing remittances, but we've gone into deeper things like infrastructure and APIs and B2B business. So tonight I'll be talking from that angle, from the operator's angle, what's working, what's not working, the real battles we are going through, and that kind of stuff. Just to dive in what you said about capital. It's true, it's tighter to raise money. And I think the best operators, the best founders thrive in periods when capital is scarce, when it's tight, because there's more discipline. Valuations are tied to actual outcomes. So they're tied to growth, they're tied to unit economics, they're tied to retention, monetization, margins, all the things that we don't really look at when there's a flood of capital in the market. I think this is good because when it's just vibes and a lot of capital coming in, you have a lot of people, a lot of tourists that are coming and starting fintechs and spending a lot of money and distorting the market. I think it's good when it's periods like this where we can focus on retention and monetization and key health indicators of a startup business. That's how I think about it. Obviously, when there's a lot of money in the market, a lot of people get funded, but I think there's a lot of jobs when that is happening. Right now, if you see people raising capital, it's mostly because they're building a real business.
Samora?
I must agree with Stone. I think he's been one of the most disciplined founders, and actually, he's been evangelizing capital efficiency even 4 years ago when the markets were super frothy. Very credible founder. But I tend to agree with him. Actually, we're doing an analysis some months back, and we found in the cross-border payment space, B2B cross-border payments, and even just payments in general, we came up with a metric of TPV per dollar raised. And it was interesting looking at that metric and looking at the companies that are just doing so much TPV per dollar raised, and it reflected a deeper sense of capital efficiency. And so I'd agree with Stone. It's good for discipline to get back into the market. Actually, from a year-on-year perspective, so far in Q1 2025, we're almost like at par with Q1 of last year. And so we expect this trend to continue. So potentially total funding raised will not be so much different from last year. But I think we're also seeing that the companies that deserve to get funding are actually getting funding. We saw last year Moneypoint raising $110 million. That's a big round, but I don't think anyone would begrudge them of raising such money. So I think that discipline will continue into the market. I think there's also more local investor participation, which I've always argued is very important for at least supporting early stage startups. So in general, I think the market is in a good place. We shouldn't just look at top line numbers as the ultimate health indicator for VC funding in Africa.
Stone, it's interesting that you've raised the bit on being disciplined, because I remember how vocal you are about your choice to grow Eversend with minimal VC and your emphasis on sustainability over growth at all costs when it wasn't popular. And I remember you were emphasizing unit economics long before it became a buzzword again. And when the downturn hit, it seemed like a validation of your approach. But there are also critics. I remember when your tweet went viral. I don't know if it was in 2023 or 2024. And some people were arguing that it can limit how fast or how far you can scale. And looking at where you are right now, do you still believe that trade-off was the right one?
Yeah, it's a very interesting balance that we have to strike as operators. I think we kind of conflate these markets a bit. So it's very easy to raise a ton of money and get into the markets and make all these experiments and pay a lot of users to join your platform if you're in the US or if you're even in Europe, although Europeans don't do it a lot. So it's not because I don't like capital. I actually like money a lot, but I also understand that it gets wasted when it is in your pockets, right? So if an investor comes in and gives you, let's say, $20 million or $10 million, they're not going to say, okay, you can run, I don't know what experiments and then run them for X number of years. They will want you to spend that money so that you can grow very fast. Now, the challenge is that by the time you raise this money, there are some things you don't know about the market. And Africa is very unique because it takes a very long time to understand the market, to understand your customers, to understand what drives them. There's no textbook. So you can't do like a Silicon Valley move and raise money and buy users. We are the kind of users here in Africa where people will join a platform just to get $1 in referral rewards, and they will never use the platform at all. It's very different in the US. People will not come to your platform because they are giving them $5 or $10 and then just leave because there was $5. So it's very easy in Africa to get the hype. And then the day you really want to monetize, what happens is that people will say, you know, that person, they are stealing money from me just because you want to charge them 0.5% or 1% in FX. But if you start from the very beginning, very serious about it, people get used to it. They know you're here to do business. You're not doing all these freebies, but also it takes time to learn and understand the market. I can tell you that we've been around now for a really long time. It's only now that I feel confident that if you give me X millions of dollars, I can scale in Y ways. But it's taken us a very long time to be students of the market and understand how the markets operate. It's very different from the rest of the world. A good example, like Samara said, is MoneyPoint. So MoneyPoint is one of the businesses that has been around for a very long time. A lot of people may look at them and say, oh, they're an overnight success, but they have really sat down and looked at the market and operated in the market and understood the market. There's fraud, there's regulation, there's free money being given out to acquire users who will never invest. I give an example that I tweeted and also posted on LinkedIn of when we had a referral program that was giving out, I think, $1 per user that you invite. We had these guys go to these markets. Funny enough, almost in all countries. In Nigeria, we had them go somewhere in northern Nigeria, go to these markets and go to these ladies and tell them, hey, the government is going to be sending you money. And then sign up. The ladies don't know anything about Eversend, but they've signed up. They've done KYC, which costs us money. They are legitimate, but they don't know Eversend and they will never come back. But the guy who is doing this is a dude who wants to get $1 from that lady signing up on Eversend, right? So it's a weird market, man. It takes such a long time to understand it. And now that we know our things and we know how fast we can grow and we've understood the market, we've fought with fraud, we've done a lot of things to get where we are, I would be happy to deploy money faster. So yes, the people saying you could have grown faster, they have a point, but we could have lost all the money if we raised 20 million and tried to grow fast. And then we'll be here today with almost the same kind of transacting the users on a monthly basis. Or maybe you're not even here because when you raise 20 million, you build a team, then you have 100 employees or 150. And then after that, you really can't move forward because nobody else is going to give you more money if you haven't really grown. And you want to grow because this market is really hard to deal with. I'm going on and on about it, but that's my thinking. So I still think that you really need to sit down and understand the market, get to a point where you can deploy money. Today, if you give me this money, and that's why we'll probably be going back into the market to fundraise, I know exactly what to do. I know exactly who to target and how to target them to get the growth that we want. We're still growing. We're still growing anywhere between 5 to 10% on a monthly basis. So it's fantastic for us, but we could have grown faster, only that we are now more sustainable. We're not looking for VC funding very badly. If we don't raise, we don't die. And that's a good place to be in, to be honest.
That's awesome. Samora, I like that you raised local funding because you wrote an interesting piece called It's a Family Affair. where you made the case that Africa's high net worth families could play a far more strategic role in shaping fintech outcomes. You aren't anti-VC in the piece, but you're clear that most Western VCs don't come with the kind of grounded networks and influence that really move the needle here, especially in fintech where regulation and policy are so central. Could you expound on that idea and why you think there's room and there's maybe necessity for more local funding, especially from the wealthier Africans, especially the family?
Thanks. I think Stone already answered that question in his previous discussion. What Stone said is 100% true. There's so much learning to be done in African markets. There are so many insights. There's so many implied assumptions people have when they're building. And then when they go to the ground, like people's behavior is so different. I really like that example of northern Nigeria and people going to the market. I'm pretty sure if Stone gave that idea to Dangote and said, this is what you think, Dangote might have told him, people might actually go to the market and look for women to sign up, right? Because he's seen such weird behavior probably in his cement or any other distribution business. And so the ultimate point I was making is that, listen, what people are trying to do is build long-term sustainable businesses that are the very best generational in nature. And so there's a lot of value of having such kind of insights, such kind of connections from day one. And ultimately, if you look at in the West, in Silicon Valley, if you raise a round with Sequoia, they're going to open doors for you. They're going to get you meetings that you didn't even know could exist. But in Africa, they just don't do that. And especially in a market like this that is so much more relational, there's significant value. Of course, it takes time to build the insights and knowledge and trust networks that would allow such capital to spread across the market. But I think it's happening slowly and it needs to happen at a greater scale. I think particularly in East Africa, because one can argue that Nigeria and South Africa to an extent have a robust local early stage and even growth stage funding environment. As that was the kind of thrust of that article.
Stone, I'm just curious from your perspective at Everson, what innovations are you observing in the fintech space this year? And how are these developments influencing your approach to product development and opportunities for growth?
I don't know if we can talk about fintech these days without talking about stablecoins, but that's the big deal right now. And I think for us, we actually are not like seriously adding any new things around stablecoins, but we are seeing the market get to a level where the stablecoins as infrastructure are getting to real usage. It's no longer hype. It's an efficiency tool. I always tweet about this. For me, it's almost like magic. The first time I used USDT to send money across borders, it was like, wow, that's so cool. That's so fast, because I was used to doing our usual bank-to-bank SWIFT transfers. They really solve serious pain. They've helped us with things like treasury management, also capital mobility, moving money around. I think the real challenge is regulation. But going back, we started at Everson, we started building in the stablecoin space, I don't know, maybe around 2020 or 2021. And we've built an infrastructure. We manage our liquidity with USDC and USDT. But right now, everybody is waking up. Even when you hear that there's 1,000 companies building in the stablecoin space, I believe that the space is so big, that opportunity is so big, that a lot of people will win, especially early adopters like us. A lot of people are scrambling now to build this infrastructure. Again, this is stuff we built in 2021 and improved in 2022, and we're still using it in 2025. So for us, it's an opportunity to scale, especially since everybody else is now picking it up. Now you can get good off-ramps and on-ramps into banking systems and mobile money systems. We're having conversations now with the central banks and regulators of all kinds. I see this picking up, but mostly because of how efficient stablecoins are as the infrastructure. I think in the beginning, it will be big for B2B cross-border payments, but then it will end up going into other things, including acquiring, so paying for things. But that may be maybe 1 year or 2 years down the road. I wrote again about stablecoins in 2021. A long post where I said stablecoins, the future of cross-border payments, and we are seeing it today. So I was very early on this one. I think to break down, maybe to see what's going on Besides stablecoins, I see a lot of people going into artificial intelligence, and I've seen some very advanced things that I personally don't understand right now. Yesterday, I was at Stripe here in London, and I saw some really cool things they're doing with agentic payments and things, platforms being able to buy things for customers automatically. Things like, if the price gets to X, you can buy this for me, and then this AI will go ahead and buy. But I think we haven't reached that level here in Africa. But there's things that AI can help with around fraud detection, KYC, especially catching things like deepfakes. That one is going to be a real big struggle. But maybe one last one is what we are realizing is the building of platforms. So people are no longer just building a nice, shiny app like Eversend. There's real rails to be built at the back. A lot of us are evolving from just a product to platforms where you're looking at Rails APIs for virtual cards, for FX, for stablecoins. And it seems the end goal is going to be people building financial operating systems, and then many fintechs not being able to differentiate between each other, because I believe that all of us are ending up in the same place. You may start from remittances, but you will do those virtual accounts and virtual cards. You may start from B2B payments. MoneyPoint now has a B2C app in Nigeria that is doing really well and competing against OPay and PalmPay. They see that opportunity has changed into platforms as opposed to just apps, products. So building a product is no longer very useful, especially since you really need to get a high average revenue per user. And if you just do cross-border payments, remittances from London to Kenya, guys are going to go to Silicon Valley, raise money and outcompete you. Then they will die and another one will come, but then they will outcompete you and you'll be out of business. That's why kind of our strategy is to give our customers multiple things. If you don't use our virtual cards, then maybe you will send money across borders or you will do 3 other things. We are seeing platforms taking over. And I think it's going to be very difficult for newer startups to get in and get things done. We really have to be clever. Even around stablecoins, what we are seeing is that right now the infrastructure is almost commoditized, where everybody is building on the other person's APIs and also selling APIs. So you have 5 people sending money for you to Nigeria. There are 5 people in the queue. So everybody needs to get paid. That's not business. I believe we will have to own our corridors instead of spreading wide, own corridors, own FX, and get real money out of the things we are building, not just building on top of APIs, on top of APIs, on top of APIs.
I think we'll come back to the stablecoins bit, but Samara, looking across Africa's fintech ecosystem in 2025, where do you see the most impactful innovations emerging from? And are there specific sectors or technologies that are leading the way?
It's hard to answer that question without talking about stablecoins. But I think just to echo Stone, it's a big industry. I remember similarly writing about it back in 2021. And the entire discussion was like, oh, they're not decentralized. You're still going back to the government and all that kind of stuff. One thing I always say is that we really need to even avoid Western literature around fintech, because the idea of decentralization as a value is, in my view, pointless. What matters is utility. And it was very clear that stablecoins provide that utility. I think it's going to be a big thing. I think that's where a lot of money is to be made. Like, you can actually build a business that is making money. And one thing I've always argued is that you don't need to think too hard about winners and losers. In my view, I think the stablecoin industry is going to present the same type of outcomes as traditional money industry and banks. You're going to have value accruing to those people who can provide a comprehensive service. And that comprehensive service means, just like Stone mentioned, the entire suite of products. And down the line, that includes layering credit on top of some of these B2B payment flows in terms of trade finance and things like that. That's where the money is made in traditional finance. I think in AI, one thing that I find interesting, I'm finding a lot of interesting companies, because AI is a data game, and everyone says that local entities have a lot of data, but it's not organized. And I think for me, a big chunk is like, how do you organize all this information so that it can actually make sense from an AI perspective? Whether those are call logs with clients, whether that's meetings and all this type of stuff around that is offline, the edge data that adds value, but can actually help the model. What I found the most interesting thing from Stripe sessions is this idea of that they actually created a generative model, and it improved fraud results from 56 or 54% all the way to like 90 something percent. It was a crazy uplift. But I think that is because they were set up to be data fast. Everything runs on cloud. So for financial services firms to achieve the same kind of uplift in outcomes, be it fraud, be it everything, they need that holistic approach to data. And I think companies that help organizations, I know of one company that's doing that for traditional manufacturing. And what they're doing is that they're just taking orders. Like, we'll plug into your WhatsApps, and when customers make orders, the AI reads it, gets context, and puts it into the company's ERP. And they're actually making traction, signing up new manufacturers every day. Just like Stone mentioned, it's hard to talk about the big opportunities in 2025 without talking about stablecoins and AI. So I'd largely echo it and sound unoriginal at my expense.
Stone, for those of us who don't know what stablecoins are and not in this space, what exactly are stablecoins? Because I remember that was the initial topic for the Twitter space, and then we realized we have a segment of the audience who might not exactly know much about this space. And what are the use case for the common person, and what will drive the adoption across the continent, and what will stall that adoption?
There's something I say that a lot of people disagree with me, which is weird. I think everybody knows like M-Pesa or MTN mobile money or Airtel money, basically mobile money. Or if you look at Europe, what we call e-money. I think even in Africa, we do have those regulations now in Kenya and Uganda around e-money, which basically is the ability to issue electronic money, have it in a wallet, but also have it backed up at a bank account. So the unpopular thing that I like to talk about is the stablecoin is just e-money. There's nothing new. There's nothing confusing. The only difference is that the ledger you're using is not the ledger built by Huawei, Ericsson at MTN or at Safaricom. The ledger you're using is the blockchain. So basically, in my head, there's no difference. And these are the conversations we're having with regulators, because I ask them, okay, you're giving us this license for e-money and asking us to keep money in our wallets, in our ledgers, and then have a backup of real money in a bank account somewhere, in a trust account, in a segregated account. That's basically what mobile money is. And then move it within the system. So from one person to another within the system, or move it out of the system into another system, or add that money into the system and therefore create e-money. In my head, that's what stablecoins are. So the fact that the ledger that I am using is the blockchain changes absolutely nothing if I can satisfy the fact that the money that I claim that people hold is actually somewhere in a bank account. Now, stablecoins would be easier to audit than M-Pesa, because you can tell the market capitalization of a stablecoin from the blockchain in public, which is something you cannot do at Safaricom or at MTN or at Airtel. In simple terms, stablecoins are basically digital money or digital dollars. If you're looking at USDC and USDT, their value is just stable and they are tied one-to-one with the currencies that they represent. So if it's a US dollar, it means that one USDT is equal to one US dollar, and that US dollar is held somewhere in a protected account. So if you have $10 or 10 stablecoins or 10 USDT, it means that $10 is somewhere in a bank account. The difference with these stablecoins is that they can move very quickly from one blockchain address to another blockchain address almost instantly. For example, if you want to send money to someone in another country, they'll be much cheaper and they'll be much faster than your local bank accounts that have to go through Swift, very inefficient, or even your mobile money platforms. But also, there are some other advantages of, for example, some people who earn in dollars, they can receive stablecoins and keep that money in those currencies in case our local currencies lose value. So I don't know if that makes sense. So it was basically a wallet-based platform where the wallet is on a blockchain and you're holding your digital money, but that digital money is backed up by another currency. Don't confuse it with Bitcoin or crypto or things where the value can fluctuate against our fiat currencies. It's just one-to-one. I think the most important thing is that it doesn't lose value. If Samora pays me with it, it will not change between when it was sent and when I receive it. What drives adoption? It's basically mostly regulatory. And right now, I think we are getting to a point where regulators are starting to listen. I've just written a paper for the Uganda Bankers Association explaining the same thing I'm explaining now. But if we get regulation to be accepting, then adoption will surely skyrocket. But we are seeing regulators in the United States, regulators in the US, in the EU, these guys are picking this up. And what happens with our African regulators and African markets and governments is that anything that is accepted by the US or the UK or the EU eventually gets accepted by our people. In fact, sometimes the regulations are picked up and edited to suit our markets. I'm not saying it's a bad thing, but usually that's what happens. So those kind of leaders in regulation. So I think that will really help. But also, if we have trusted apps building this. So we spoke a bit about Stripe. So now Stripe is selling this thing they call digital dollars, which is basically stablecoins to almost all companies around the world. They say they're doing it in 100 countries. So if you have someone like Stripe actually selling something, I think people pick that up. I always say again, trying to change mindsets alone, it doesn't help. If guys like Pampe or Pay, Cheaper Cash didn't bring their billions and drop them into the African market, we would probably not be where we are. I believe collectively we can change markets. So I don't really believe in that whole competition, kill each other thing, because when we are together, we push together. So if Stripe is pushing this and somebody else is pushing it and MasterCard is issuing cards based off of stablecoins and Visa is doing the same thing, I think eventually we all win, especially those of us who know how to pick out a small niche and utilize that to bring real value to our customers or the businesses that we work with. To go back, regulatory clarity is one of the biggest ones. When governments understand these stablecoins, when regulators understand them and not fear them, it will allow better integration with our local banks and mobile money, and then that will be super cool. And usage will definitely increase. What kills adoption is pretty much the same thing. If regulators against it and still looking at it as that your things or your crypto things or scam or you will lose money. If there's clarity with people like what I'm trying to do, speaking to regulators, building around this and saying exactly what I'm saying, stablecoins is just better e-money. It's just better M-Pesa. It's that simple for me in my head because it is instant, it's fast, and it can move across countries and across all kinds of normal financial blockages that we have in the banking system. That's how I think about it. Thanks.
Samara, I'm just curious, like what practical use cases will a common mwananchi use on a day-to-day basis? And then number two is, I remember on your podcast, Nikolai from Nala mentioned that he's bearish on stable coins in the short term, but bullish in the long term, mainly due to regulatory infrastructure challenges. And if you could just speak on that.
Okay, so I'll touch on two things, but let me start with the Nikolai one and then end with the common 180. I think for Nico, as a remittance company, for them, when money is moving from the global north to the global south, it's pretty smooth. If you've ever done a wire transfer from the UK or the US to Africa, it's pretty smooth. And sometimes you get same-day credit. When you're now making a payment from Africa to the rest of the world, then it becomes quite difficult because compliance checks kick in. Where is this money? Who has this money been sent from? And so that friction is what's creating the massive stablecoin opportunity. Money going out of the continent, first of all, you have to source dollars and send them. Money coming in, everyone is welcoming it. And so it's quite smooth. So I think his point was largely as an executive in a remittance company saying that in the remittance space, I don't see the massive difference it makes, at least for our industry. And that's his own personal perspective. And I think there are some valid reasons for that. So that's specifically as a remittance company. If you look at now from international payments, like Africa's making payments outside, a lot of the players are doing incredible volumes. And these volumes are growing on a monthly basis. And so there's a very strong product market fit when it comes to Africans paying the rest of the world. Some of the numbers I'm hearing, it's incredible. Now, will a common Mwananchi citizen use stablecoins? At least they use M-Pesa, and that's a stablecoin, as Ton mentioned. But I think the question is, Sumaya, how often does a common Mwananchi hold dollars and make dollar payments? I think that's the question to ask. And the reality is that a common Mwananchi, the guy on the street, is not interacting a lot with dollars. So in my view, it's not something that he will interact with. He may benefit from it from a secondary perspective because now the guy who's importing like equipment to fix phones finds it easier to import that equipment, and it now helps the local mwananchi. So that's like the mechanism in which stablecoins will filter through the regular citizen through the import mechanism where people find it easier to import, potentially prices get lower, or at least products are more available in the market, and the common citizen can benefit from that. But if the common citizen does not use dollars on a day-to-day basis, the people, at least at a very local level, they need to buy food, they need to take their kids to school, they need to go to hospital. And so far, they're doing that on M-Pesa, or at least on cash. So they may not need to use stablecoins.
I remember there's something I saw you tweet sometime back, which was stablecoins is going to facilitate or rather increase intra-African trade and also make it possible for more Africans to trade globally.
It's true. Even if I'm making a massive payment from Ghana to Kenya, it usually has to go through North America. And so stablecoins make that much easier, at least in the very sense that having this kind of global, as Stone mentioned, the way I think about stablecoins, using the M-Pesa analogy, is that if Safaricom was in the entire continent and if everyone could access a Safaricom line or an M-Pesa line in the entire Africa, and you could have a dollar wallet on M-Pesa, then money would move easily amongst all of us in Africa, right? The only reason that's not possible is because M-Pesa is not everywhere and M-Pesa doesn't have a dollar wallet. So insofar as you can think of stablecoin transfers as having a Pan-African M-Pesa, then it should help intra-African transfers. And that's what I meant when it says it should be easier to make payments to the rest of the continent. And I think the likes of Eversend, their job is going to be to make it feel so seamless that the person who's in Ghana doesn't know that he's receiving stablecoins, and the person who's in Kenya doesn't know that he's using stablecoins. I think that should be the magic of stablecoins.
The common man may not touch stablecoins himself, but like Samora says, is benefiting from them in one way or another. So if, for example, even just going back to remittances, if somebody is sending money from London to Nairobi and they're using Eversend, in the back, there's some stablecoin involved. And it's just making the transaction smoother and faster. Therefore, the common guy somehow benefits from that. If a Ugandan restaurant is importing fish from Mombasa or from wherever, and they do a cross-border payment on Eversend, in the back somewhere, there's some stablecoin involved to make that smoother. If somebody is sending, this is a real example, is sending Uganda shillings to a student in North America, just $200. This I have seen with my own eyes. There's stablecoins involved in the back. And instead of this transaction taking 3 days or 2 days through the Swift platform and you being charged $50 or $60 to send 200, it's now costing the guy maybe $3 and 0.3% or 0.5%. And there's stablecoins involved. So there's a lot of improvements for the common man. Maybe not the guy on the street hustling day to day, but it will still come to that person when we start thinking about local currency stablecoins. I think the Nigerians already have CNGN, and there's a lot of efficiency that can be picked up from here. One other interesting one is importers. So importers in the markets in Nairobi make payments to their guys. Maybe sometimes they use the Hawala system, or they make payments through banks and the money goes to New York and then is exchanged back to some other currency and sent to China. Now with stablecoins, you can literally help that guy to make an instant transaction to China and get their imports done. This is the beginning. We are building a product right now for remittance companies. You guys just chatted about remittances, and I'll tell you one interesting one. Just basically how a remittance business works is, let's say World Remit will collect money. They will have their own money from their own treasury. They'll send it to Nairobi, to their partner, let's say M-Pesa or a local bank. And they'll say, maybe they are sending, I'm just guessing, $2 million a day into Kenya. So what they will do is they'll say, okay, we need to send float for 5 days, 4 days. So they will send $10 million from their treasury, and they will exchange that to Kenya shillings and let it sit locally in a bank account or exchange day to day. We're building a product that I call, this is my own words, which I've just concocted, just-in-time funding. So basically, this product, what it will do, based on our license that allows us to send money into Kenya, we will hold our Kenya shillings. We will tell our partner, who may be World Remit, a remittance company, and we'll tell them, don't send us your money. Don't send us your $10 million, okay? Keep your money. Every time you hit this API, you will hit the API and it will say, I want to send $10 or $100 to somebody in Kenya on M-Pesa. Then we will send you back an exchange rate, which you will be able to give to your user and add on your own commission. Then you will send us back a transaction and say, okay, we would like to make this transaction. So the user will pay you. You do your business how you do it in London. And then we get that transaction on our platform back here and we wait. Now we tell you that you can fund this transaction with stablecoins instantly. So when you're ready, when the customer has paid you and you've confirmed, you will go to your treasury where you have USDC or USDT or maybe a GBP stablecoin or a Euro stablecoin, which Eversend accepts. You will send us that $100 plus maybe $1, which is our fees. Your guy in London has paid you $105. You will send us $101. You'll keep your $4. We will deliver your money instantly, just in time funding. So imagine for a remittance company that is sending multiple transactions, millions and millions of money to multiple countries, how much more efficient they can get if they have to keep their treasury with them, as opposed to sending it to some company that they deal with in Nairobi to hold Kenya shillings for them. Just from an operational point of view, imagine the cost savings and the peace of mind that kind of remittance company would have. So again, the man on the street doesn't need to see stablecoins. Nothing is happening. The guy in London who is sending Stone, who is sending from London, doesn't need to send stablecoins or anything. But between the two players who are playing in this space, we are making it as efficient as possible. I would say maybe 10 times more efficient, both from a capital angle. As a remittance company, I believe that's one of the biggest issues. Prefunding your partners everywhere in the world. People have 10, 15, I believe World Remit may have 20 people in their treasury department, just so that they can manage these balances on a daily basis, hourly basis. That's how it starts. And these things are already happening. We are already doing something which is not live in our B2B platform, but which we have built, where somebody will stand in Nairobi, give us Kenya shillings, and we will shoot out Chinese currency instantly. Because we have a partner in China that you can send stablecoins and say you pay out in Chinese renminbi. That's the kind of initial use cases that we will see. And then it will start getting more usage as more companies use it, as more businesses use it. We'll get to a level like now within Eversend where we can give you a wallet and then you can be paid as a freelancer or a remote worker through stablecoin. And once you receive that stablecoin in your Eversend wallet, you can change it into Uganda shilling, Nigerian naira, or Kenya shilling as and when you want, and cash out into M-Pesa, into all these currencies. That's how I think about the remittance angle. I think the opportunity is already here. This is already doing tons of volumes in many places, and we are working very hard to support others as well.
So, and since you brought up the remittance bit, last year Africa brought in almost 100 billion in remittances, about 5% of the continent's GDP. Yet, 3 out of every 4 cross-border transactions in Sub-Saharan Africa still happen informally, through agents, back-channel networks, hand carry. And at the same time, despite seeing all this momentum on platforms, which are offering faster, cheaper cross-border payments, even settling in minutes, yes, there's momentum, but still a lot of that is happening on those hawalas. And I saw that Capital believes that that amount is going to move from 100 billion to 1 trillion a year by 2035. I'm just curious, even with better pricing and faster settlements, 75% of flows are still happening informally. What do you think is behind that gap? And what has to shift for platforms like Eversend to absorb more of that volume?
That's a nice one. One, I think the main thing is trust. Mostly as Africans, we have very low trust in formal institutions. So Hawala works. Hawala solves real problems that most times, like banks, for example, fail to solve. So the systems actually work. So Hawala really works. There's trust and there's low trust. For somebody comes and want to move money and you tell them, what's your ID? Where did you get your money from? And all those kinds of things. You may say it's good for things like anti-money laundering angle or countering of financial terrorism, but I don't want to do it. I want to send money to my guy. And then there's this Chinese man, Nairobi, who say, if you give me shillings today, I will make sure somebody in Guangzhou or in Shenzhen pays out to a local bank account. So people use it because it works. But as we governments, we will continue to nibble to get a bit more of the business that the hawalas have, because we are becoming as efficient as the hawalas. A lot of people don't understand, but hawala is one of the most efficient ways to move money. I pay in a shop and my sister or my cousin or my business partner picks up in a shop where they are. It's like simple, clean, no wahala, no problems. So it works. But as we make it better and faster with the formal channels, we will keep eating up more of that business. So things like opening a bank account, they take time. If you go on Eversend, they're telling you, twist your head, do this. I don't know, give us a video selfie. Somebody may say, these people are wasting my time, okay? People need money, they need it today. You're telling me you roll your head in a selfie. No, it doesn't work. I think mostly it's around the fact that it's inconvenient to use some of these systems. It's inconvenient to use banks. It's very convenient to use Hawala. Hawala is almost always instant. They don't tell you come for the money tomorrow. You just call your guy and you say, I deposited the money on the street in Nairobi, and then the other guy gets it in China. But I think informal systems like Hawala will gradually reduce, and it's a process. This thing takes time. It really takes time to change behavior. And that's why I was saying that the more of us that are in the markets, the better, who can keep providing these services so that people don't say, oh, it's an Eversend thing. No, people say it just works. Like virtual cards is a good example, I think. Let me end with that just to show you. When we were selling virtual cards as Eversend alone in Uganda, we had some good numbers. We were growing, but people were not interested to listen. When the two big telcos, MTN and Airtel, introduced their virtual cards 2 weeks apart or maybe 1 week apart, I remember I was in Uganda. No, I was not in Uganda, but I went soon after. And then they have all this money to do all these massive billboards and radio things. And what we thought, my team and a lot of commentators were worried, oh, these guys are going to lose because our product is objectively better, is much, much better. Our virtual card products, what we saw was growth with competition actually coming. What was happening here is the virtual card is being validated by a big guy, right? Because Airtel and MTN Mobile Money introduced them, a lot of people said, okay, I can use virtual cards. It will save me from all the fees that my bank puts on me. And then as soon as you get into the virtual cards, you realize that the charges are not that great at the telcos. And then some people are saying, oh, we use the Eversend one. So we saw growth instead of seeing a reduction in the number of people using our services. So I think as more of us build these platforms, then a lot more people are going to be converted into using those platforms as opposed to staying on informal systems like Hawala.
Samuel, when it comes to AI in African FinTech, where do you think the real unexplored opportunities lie? And what's still missing before AI can meaningfully shift outcomes for FinTechs across the continent?
That's an interesting one. I think of AI more as like from a financial services perspective, not necessarily just for fintech. And I think that the people who win in AI are the ones who are going to I wrote about it some time back, that when platform shifts happen, such as the API and cloud, for instance, you have to build your business around that specific platform shift. And so you have to make a bet, just like Stripe made a bet all those years back that we can orchestrate everything around APIs. And so I think in fintech is to say that this thing is here. AI is only going to get better, in fact, increasingly so. And so build your entire business around AI. I don't think it's the kind of thing where you say, we are going to use AI for customer service, and that's our AI strategy. AI has to be embedded across the entire business. And so that's how I think about it in terms of like how to embed AI. When I look now forward in terms of what kind of real breakage it can make in terms of the financial services industry at large, especially in Africa, I wrote some time back that guys like Eversend, Safaricom, everyone, transactions are improving. Like the transaction problem, while it's not necessarily 100% solved, it's being solved, right? And it's easier for Africans to get access into basic transactional services, but not the entire suite of financial services. And so for me, what I find very interesting is that when you get AI to the point where now it can offer a holistic financial service, and what I keep saying is that having a private banker in your pocket, someone who actually helps you manage your entire finances from day to day, has a holistic view on upcoming cash flows, what you need to do this month, how it feeds into what happens next year, the kind of bespoke private banking that costs a lot of money and is only accessible to a few. I think if you can deploy AI so that becomes now easy for everyone. And what I think is specifically important is not just in Africa, but across the world, money conversations come with a lot of shame. I didn't save as much as I needed to. I'm overspending. I don't want to tell my banker, they may judge me. I don't want to tell them that I don't understand what interest is. And so I think AI can actually break a number of those barriers. And I think from a fintech perspective, it's a long bet, but I'd bet around that. I'd bet around, let me create something that will just now be a completely relational AI, drawing data from everywhere. Outside of that, of course, fraud and compliance. And the risk here now is that you're going to have bad actors that are using the same AI you're using or even smarter to outthink you. But if you look at what Stripe did with their general model on fraud, then the impetus to actually adopt AI from a financial service perspective to do things like compliance and risk becomes super important. But the thing that I find very interesting is now the relational aspect and the entire customer service aspect.
Let me play the devil's advocate here, because Zach from Plate pointed out that while AI is increasingly used internally within fintech companies, its adoption on the customer-facing side remains limited. And he claims that it's largely due to structural challenges around AI implementation, especially issues related to data access, the sensitivity of financial information, and how data is integrated into predictive models. And granted, we're operating in very different markets. I'm just curious, where do you think it's coming from?
Some of those reasons you've pointed out, structured access to data, I think he was just selling his business and saying, if you work with Trade, we can help you structure your data and now do some of these things better. You have to read between the lines. I think what people are doing, if you look at what across the world people are doing, if you look at JP Morgan, if you look at Goldman Sachs, if you look at some of the large banks in China, WeBank, etc., it's a slow kind of phased learning. And you're starting with internal agents or internal AI that is helping internal staff, right? And just because as this thing gets better, we also need to build our muscles around it. But slowly now it's starting to move into the customers facing side. And I think China is doing very well in this regard. I think one of their largest banks has built a multi-billion parameter model and it's already customer facing. WeBank is already now offering customers advice and having companions for their SME on the same principle, right? The same principle that you can actually use AI, the same service that we are providing high net worth or large corporates, you can actually provide it to an SME at a fraction of the cost. And so I think that's my long-term bet. It's not happening now, but I think that's where the market will go. And if you look at, for instance, what ChatGPT has done, I think it's amazing the levels of trust people have with their own GPTs. The kind of conversations people are having with their own ChatGPTs is incredible. And if you look at how it has affected the broader AI market, ChatGPT has built that kind of brand loyalty. And I just think that there's space for someone to provide such an incredible financial ChatGPT that interfaces with your money to create now the same kind of brand loyalty in the long term.
There's been a rise in AI-powered financial frauds and threats, especially with the deepfakes. And we've seen just how serious this is getting. And we've seen that in markets like the US and UK, over 40% of financial institutions reported fraud attempts involving deepfakes. And that's just what was being disclosed publicly. Stone, I'm just curious at Eversend, how are you thinking about fraud prevention in the new era of AI-enhanced scams, especially with deepfakes and synthetic identities becoming more common?
Something that may not be true that I'll say is, I think our fraudsters may not have leveled that yet, but it's going to happen. I think AI can help us fight this fraud, but it's also helping the fraudsters with the deep fakes. People able to generate fake selfies. I don't know if we have seen any AI generated selfies on our platform for KYC. But yesterday, again, at Stripe, we were talking about deepfakes that imitate real people's voices and faces. Like when you call somebody to confirm something and the voice is real. Obviously, forged documents are a big deal. But I think what we have to do is use the same AI to improve our system. So those liveness checks have to be done. When you're signing up and we tell you, please bring up your face, roll your head. That's called a liveness check to make sure that we are not looking at a still picture, motion prompt, move in this way. The AI may not be able to do that now, but it will be able to do that later. There's some other ID tools that we could use, but a lot of security companies are now building what they call AI detection models, which would be able to help detect these deep fakes based on deep fake patterns and make sure that every time you're working with somebody, you're working with humans. So I think the systems are adapting, we're adapting. AI, I think, while it produces these challenges, is also extremely useful in very many ways to build smarter systems. Anything that improves efficiency comes with upside and downside. To go back maybe just a little bit on the use of AI, I think I disagree and agree with Samara. Where I disagree, I says putting it in the whole system. I believe that's the best way to do it. But in the early days, there are some very quick wins that you can have around fraud detection, suspicious behavior, risk scoring. These are things you can do very quickly. Automated customer support, chatbots, and training them on our data, like historical data, so that they can resolve quick issues very quickly for the customer without having to get to an agent, which also helps you to reduce the number of agents. And AI can do this work very well and reduce ticket volume by giving customers real good answers and real fast answers instantly. Again, like I said, identity verification and KYC, you can reduce manual review by building some things around AI that can read documents or detect anomalies. I think this was like the very first use case of AI because we've been using this from some of our providers of ID verification for years. Like from the very beginning, they've been using a bit of, I don't know if it's real AI, but a bit of auto detection of things on documents and stuff like that. And then, like Samara said, personalized financial recommendations. There's one big one, which is like a big tree, which is in customer acquisition, where you basically tell the artificial intelligence, like, for example, in Google Ads, that I would like customers who look like my best customers. So you just give them your best customers, and it looks for customers who look like your best customers by just looking at all the different small things they know about that person. It's just ridiculous how efficient acquisition can get. But lastly, I think one big one, and again, Paul is here, one big one for us is improving internal efficiency and operations. Things like legal documents, things like strategy, a lot of things. We're just using AI to make sure that we work much faster, we work more efficiently. A lot of people will just say AI, and then you'll see people who write a lot of just AI gibberish the way it has provided it. For somebody who already knows what they're doing, AI can be incredibly great. On the deep fakes, we have to stay at the forefront of what is happening and what's possible and keep our ear to the ground and eyes open. But I think there's more advantages, much more advantages for the people who are ready than disadvantages from artificial intelligence.
We can take audience question. Anthony Magayu asks, the underlying fear of stablecoins in government and banks is loss of control of data.
Anthony makes a good point. E-money, if you look at the e-money framework, what it is that you're saying that if you're looking at it from a central bank perspective, so if you think about stablecoins from an e-money framework, put the money in this bank and then issue e-money that corresponds to what's sitting in the bank, and everything is okay. If you drill down, that bank is monitored by the central bank and is making reports to the central bank, and the currency is controlled by the central bank. The big now friction now that comes in is that this kind of stable coins, the money is sitting abroad, right? And in as much as we understand the e-money framework, we don't have the control that we have with local currency e-money frameworks. And that brings its own risks from a Forex perspective. And of course, some of these Forex things, especially in Africa, have got implications in terms of inflation. So as it really scales, if it really scales, then it's going to have like macro issues, and it's something that the industry cannot just wish away. And so even if you look at what markets in crypto assets regulation for Europe, one thing that we're clear about is unpopular, but they're clear about is that whatever stable coins, even if they're dollar stable coins, they need to be sitting in European banks. And that's the core thing. Anthony is right. And it's something that I've kept arguing that the industry cannot just wish away as a potential risk that is flagged by the central bank. And I'm sure conversations are going in terms of how you can mitigate some of these risks.
I think, Samara, you've given us the answer there. One of the things I think to realize is that the stablecoins are not going away. How do regulators on the continent play within, still get access to the data? That is the question. So now the first thing is increasing the use and regulating local currency stablecoins, because those ones you can say, we want to see the data. The second thing is, instead of fighting them, regulate them. So when you regulate the players who are issuing these wallets, at least to the people in your jurisdiction, then you have the right to say, okay, where is this money sitting? So stablecoins is not just USD, but of course we use USD denominated stablecoins a lot because dollars are what trades the most. Like Samora said, around Europe, what they're saying is that even if it is a USD based stablecoin, we need you to hold it here. So if you require licensing, you require KYC, you require reporting, maybe even API based reporting. If a transaction happens, somebody who's registered on the Eversend platform in Uganda, you require reporting of that transaction. Then I think you can mitigate some of the risks, not all of them, but some of them. So if you treat them like actual digital money or digital infrastructure, not threats to your government, you can get a lot more control. I think what's dangerous is banning, because as we've seen, I think from experience, is that doesn't go very well. When you regulate, any kind of regulation is good for us, the players, is good for the government, and is good for everybody else who's not trying to cheat people, who has nothing to hide. So regulation, I think, is a big solution there. And that's why I think a lot of people have been talking about CBDCs, which basically I think stablecoins controlled by the central bank. But there are solutions to most of these problems, not all of them. But when you regulate, you get insight, you get your eye on the problem.
100%. And just to echo Stone, the regulation needs to be very clear around e-money type regulation. And right now, the thing is saying regulation at all costs. But I keep saying, if you're a nasty central bank and you don't want these things in your market, you don't have to ban them. You just have to tag them as digital assets and introduce a tax. And what needs to happen is that the communication needs to be around same type of e-money regulation for dollar stablecoin players, so that they're seen as a payment tool and not as a security or an asset.
Meditations ask, I'd like to know your thoughts on how the growing interest of nation states and central bank digital currencies affect the fintech space. Seems like most governments across the continent are exploring this, from Nigeria to South Africa, Kenya, Uganda.
Maybe I can just take quickly. I think CBDCs are a very interesting topic. For me, the way I look at it, and Stone mentioned earlier that the way to think about stablecoins is mobile money, right? And I wrote some time back that the innovation for mobile money was that we are just going to distribute it differently. Whereas traditionally, money has been distributed through banks and branches, we're going to distribute it through the mobile phone. If you think about the deposit at your bank, it's an electronic deposit and it can move within the bank easier because they control the ledger. Now, if you look at Africa, for instance, we look at Uganda, Kenya, etc. Digital money exists. In Kenya, in East Africa, more so, because East Africa has really taken on mobile money, which I think is the native way of being digital finance in Africa. So CBDCs don't, in my view, interesting, but they don't necessarily solve a specific problem. But central banks may be forced to do them, because they may not be forced, but they are considering them because they have a mandate to make money available. And if money is becoming digital, then they have a mandate to make digital money available. And that's more like the role of producing cash. And cash is a public good, because if you don't have access to cash, then you cannot transact. You're left out of the economy. And that's a key concern for the government. And so that's part of the broader discussion. From a CBDC perspective, I think the most interesting discussion is around the digital yuan. And I've always argued that if you look at how money flows, it flows according to how goods flow. And that's why you can't talk about money cross-border payments in Africa without talking about China. And I think that's a potentially interesting thing to watch if the Chinese digital currency becomes in itself a replacement of SWIFT in the long term. I think that's, in my views, the most interesting CBDC project because it has global implications.
I probably wouldn't add much, but again, the way I think about CBDCs is they have upsides and challenges. So one of the big ones is that central banks could very easily bypass other financial institutions, because if you hold CBDCs at CBK or at Bank of Uganda or at the Nigerian Central Bank, then what do you need a bank for, or what do you need Eversend for? But I don't think that's going to happen to make us irrelevant. For the biggest challenge that I have personally with CBDCs is full visibility, transactions, which with cash you can't see. With mobile money they can see, but they can see through reporting. But CBDCs means they can look at the ledger, they can look at the blockchain, and they know who paid who, when, and for what reason, even if they ask. Some of our businesses thrive on trust. I think CBDCs could be very highly surveilled by the regulators. So those are the challenges, but I also see big opportunities. So again, I am a big proponent of instant settlements. Obviously, if they did them and they implemented them well, they would give us direct access to these nice rails where you just hold a CBDC in your app, in your Eversend app, and it would even possibly lead to increased trust for some of the fintechs. And there are some other good things around distribution that we can achieve, including things that we no longer talk about. I remember 5 years ago, 7 years ago, we were talking about financial inclusion. I think a lot of people realize that there's not much going on that side of things, but I think government could very easily do, what do you call those free monies that they send to people who need support and help? So the central bank or the Ministry of Finance could directly send this money to all the people in need and remove all the middlemen, remove Eversend that wants to take a cut or to send this money on behalf of the government. And remember what you said, the CBDC would just go to somebody's phone and they can cash it out at an agent. You basically don't need much. So I think there's good things and bad things. I'm not sure if I like them or hate them. But I think implementations we've seen have not been amazing. The Nigerian Naira one didn't go very well. I know that a number of central banks are looking into them as well, but the implementation has not been great. So I don't know how that can be improved. But I don't have a positive or negative stance on them.
Okay, our time has reached. So we just say thank you to Samara and Stone for joining us today and sharing your valuable insights. To our listeners, I encourage you to subscribe to Samara's newsletter, Frontier FinTech, and podcast F Squared if you want to stay up to date on what's happening in the fintech space, gain a deeper understanding of Africa's fintech space, and hear directly from operators and founders driving innovation. And if you live abroad or have loved ones sending money back home, consider using Eversend. They're a platform that makes cross-border payments easier and more affordable for Africans living in the diaspora. Thanks once again for tuning in to Bongo Capital Tech Spaces. We'll see you next time.